How's it going, friends and family? My name is Amos, and welcome to the Dividend Compounders with Cheese Public Portfolio Series. In this video, number one, we'll be going over the drastic transformation that has happened to the portfolio. Number two, we'll be answering the question as to why I do not drip my dividends. And then number three, what do I really mean when I say I'm going to jump into a position? And much, much more. There's a lot to talk about, so let's go ahead and get into it. But before we get anywhere, let's go ahead and take a look at the portfolio as it stands today. The total return is 145%, of which $35,000 is the realized P&L of the ones that I sold for profit. Dividends received, $1,700. Obviously, if you only take a look at it today, then I'm down by, $220. That's because I feel like except the big tech Mag 7 stocks, everyone else was pretty much in the red. But it's only one trading day. I don't really think about it too much. It's short-term noise. If we jump on over to the holdings tab, you will see that the portfolio is a lot smaller than the last episode. The biggest holding as of right now is Microsoft. That was intentional. Remember, I kept saying I wanted to make Microsoft my biggest position, and it is. And it seems like besides Microsoft, I'm pretty much in the red with everyone else, but that's okay because I just started a position in S&P Global. Same with SAP, which is the European version of ServiceNow, and the trade desk. Every week, I contemplate whether or not I just want to cut my losses. However, let's fast forward. Let's not focus on the negatives. So let's take a look at the portfolio's performance up against two benchmarks, the S&P 500 and the QQQ. Click compare. So the Dividend Compounders with Cheese portfolio year to date, 25% is the total return. In the exact same time period, the S&P 500 is 13%. And the QQQ is 18%. All things considered, not too bad. I'd be lying to you if I said I wasn't pretty happy with the results. Now let's talk about the positions that I sold out of. First and foremost, my goodness gracious, I can't believe it finally happened. I sold out of Huntington Ingalls, the military industrial complex player that makes pretty much all of the carriers, destroyers, and sea vessels for the United States Navy and Coast Guard. If we scroll down to take a look at it, the total profit was 137%, of which the capital appreciation that I sold out of, $2,262, and the dividends received during that time period was $68.10. And the reason why I sold out of Huntington Ingalls was because over the past 4 months, the run-up in the military stocks, it doesn't matter if we're talking about General Dynamics, Northrop Grumman, L3 Harris, Lockheed Martin, every single one of them, the valuation was just bonkers. It didn't make sense to me. They were grossly overvalued, and I get it because of all of the conflicts around the world. People were plowing their money into the biggest beneficiaries from those events because of the supply of drones, missiles, and all the various technology that's being utilized. And for me as an investor, I didn't want to just sit back and hold. Because if you take a look at what's happening in the past 3 weeks, the military stocks left and right, they're selling off pretty darn hard, which is why stock number 2 that I sold out of, Lockheed Martin, ticker symbol LMT. It's the parent company of the F-35 fighter jet planes. And my total profit, baking in the dividends, 47.9%. Dividends paid out $163.80, the exact same rationale as Huntington Ingalls. I think for the next 3 to potentially 9 months, I think the military stocks are going to continue to fall back into normal valuations because right now, I think it's a little out of control. And that's why I don't feel any remorse or regret in taking profits while I can. And as we talk about stock number 3, if you follow the Compounders Corner, which is the weekly earnings podcast that I upload every single week, around an hour and a half long in duration, but you get a lot of good nugget of information, insights, and research, all for free. Well, I think 2 episodes ago, I revealed that the family and I, we are moving back to the United States from Japan. Between you and me, I'm so excited. I'm sick of living in Japan. I'll say it. Okay, I think Japan is a fantastic place to vacation or travel or visit for a week or two. I think when you push it to 3 weeks, you're overstaying. You start to feel the stuff that I am just over with. And I'll tell you this right now, to live and work in Japan is an entirely different reality than vacationing here. Okay, so having said that, I'm super excited to go back to the US because there's several things that I'm going to be launching once I'm back on US soil, including live streams, merch. There's a lot of stuff that's going to happen with the channel. Now, because I'm moving back to the US, there's going to be a lot of big ticket purchases that need to happen, such as a new family minivan or an SUV, I guess. We need to buy a new computer because the one that I've been rocking, dude, he's pushing 6.5 years. He is huffing and puffing because I have been pushing him full throttle every single day, filming, streaming, editing. I'm not just a light computer user. And I genuinely pray that my computer can last another 2 months or so, just in time for me to replace him. We also need to get a new cell phone for the wifey, and I need one as well. So needless to say, that's thousands of dollars of capital we need. Okay, so having said that, stock number 3 that I sold is United Health, ticker symbol UNH. And if you guys remember last year when the health insurance stocks were all going on the sell-off across the board, I was buying the dip. I bought into Centene and I bought into United Health, and the total profit, baking in the dividends, 33.4%. So $3,352, which I feel pretty blessed and grateful for. I certainly do think that United Health is a $600 a share stock, at least in the next few years. But for that to play out, we're talking about 700 to potentially 1,000 days out. And unfortunately, I need the money right now because of the big pending move back to the US. I don't know about you, but it's pretty expensive to go from Japan to the US, especially with the debacle happening in the Middle East and the fuel charges for flights, transportation, logistics, and the moving company. Just everything gives me a headache right now. But anyways, this one right here, I didn't want to sell, but I had to. I need the money. Stock number 4 that I sold out of is Cisco. This one right here, the total profit for Cisco is 102.2%. or $982.17. And I've owned them since, I think it was like 2022 or 2023, $94.92 in dividends since that time period. And it's really simple. For Cisco, I had their fair valuation at $88 a share. And at the time of making this video, they're $89.57. And so selling out of Cisco, it wasn't a very difficult decision. Stock number 5 that I sold out of is Amazon. At the time of making this video, they're $263. No, I did not time it perfectly. If you take a look at their stock chart, you can see that Amazon has highs and lows. The volatility in the stock market since 2024 is a primary reason as to why I sold out of them. But reason number 2 is probably the bigger driver, and it's that I have Amazon's fair value at $255 a share. And so that's exactly the price point that I sold out of Amazon. The total profit, they don't pay a dividend, the total profit, 22.9%. And I'm okay with that. I'm happy with locking in and raking in the gains on Amazon. Now, this is a high quality compounder that I would love to buy back in if there is a pullback or a correction. And with how things have been in the stock market, I think my opportunity will come sooner than later. And then last but not least, stock number 6 that I sold out of, Progressive Corporation, ticker symbol PGR. And the reason being is that after tuning in to their most recent earnings, I plugged and chugged the numbers from their guidance to my analysis, and I found out that Progressive, as of right now, they're slightly overvalued. While at the exact same time, Microsoft, they were selling off, and I saw them as an undervalued opportunity. A high-quality dividend compounder with cheese on clearance. So it's a pretty simple setup. I rolled over the capital from Progressive into dollar cost averaging into Microsoft. And that's the decision that I would do 10 out of 10 times given the option every single day of the week. No regrets. Now, having said that, if Progressive does sell off or we see a correction and they go below $150 a share, that's when I'll open up a position and enter back into Progressive. But for the time being, I could be wrong, but I do think they're overvalued by the slightest of margins. Now, I do apologize up front for not uploading videos more frequently. It's just my hands have been really full. But do keep in mind that all of these transactions that I just went over, the Patreon community, they found out as soon as those trades were made. So I'm talking about weeks ago. And that's one of the perks of joining the Patreon. Not only do you get to support the channel, but you also get to find out about my trades, buys and sells before the YouTube community. And now let's go ahead and address why I do not drip and what I do instead. And if we take a look at the compounders portfolio, for the trailing 12 months, the amount of dividends paid out by the positions, some of them are gone now, such as Pepsi, such as United Health, such as Apple, in congregate, $1,147.80 in dividends. But interestingly enough, you would assume that the biggest dividend payer, the stock that's responsible for the bulk of the 1,147, would be some ridiculously high dividend yield payer, but that's just not the case. It's actually Microsoft. And that's because I bought into Microsoft a long time ago. When I first got into the stock market, it's probably one of my first purchases. So 18% of all the dividends paid out is thanks to Microsoft. Shout out to Microsoft. So I think based on my understanding, most investors, they turn on DRIP for their brokerage account, whether it's going to be with SoFi, Fidelity, Vanguard, Charles Schwab. And essentially what DRIP does is it reinvests the dividends right back into buying more shares of whatever paid that dividend. And that's why it's called a dividend reinvestment plan. So if you have 5,000 shares of SCHD, by using DRIP, when SCHD pays out their quarterly dividend, it'll turn into 5,044 shares of SCHD. And you keep doing that again and again and again, you can see why it's the dividend compounding snowball machine. And between you and me, there's nothing wrong with that. And I would even say it's an optimal way to be hands-off when it comes to investing. And over the long run, that form of passive investing will be more than fine. However, what we do have to keep in mind is that I do this investing thing full time as a content creator, which means I like to be more hands-on and I want to try and beat the market year after year. And as an active investor, what people don't talk about is how stressful it can be when you make moves outside of VU and chill, because I feel like that's the mainstream investing advice, which works. And that's why I endorse it and I think it's coherently sound. Because I don't do that, in the short term, even my best ideas can go red and make me question everything. For instance, if we jump on back over to the portfolio, if we take a look at Procter & Gamble, SAP, S&P Global, I'm deep into the red. And if I was a day trader, I would be in big trouble. And I would be losing sleep, my hairline would be receding. However, over a longer horizon of like 3, 4, 5 years, potentially 10 years down the road, if my investing thesis is sound and I stay disciplined, those positions, they usually have a way of working themselves out. And that's why I'm not worried. We talk about Procter & Gamble, SAP, S&P Global. I know I'll be okay. When it comes to the trade desk, I do think that one might take more time. I don't know how much more time, but that's an asset that I do have on my side. I'm only 35, right? So if I don't drip, then what is it that I do? So when I get paid dividends from my holdings, I put it into a money market fund. And this is done automatically on my brokerage platform. That way, my cash can earn a yield instead of just staying as cash. Because cash by itself, if you don't do anything with it, it loses purchasing power over time due to inflation, What I mean by that is your $20, 20 years from now will have less purchasing power, right? Just think about the cost of gas, the price of eggs, the price of almost everything in the United States from the 1990s to the 2000s to even 2026. The price of almost everything slowly goes up. And so the value of that dollar, if it doesn't keep up with inflation, you're not doing yourself a service. And that's why I put it into a money market fund. But the dividends don't sit in the money market fund for too long because I'm constantly buying. Every single week, regardless of what's happening in the market, I'm picking up shares here or there. And I do that by looking at which stocks on my watch list. By the way, I have 100 stocks on my watch list. That way I can systematically buy without even thinking about like, oh my gosh, should I go with X or Y? They are ranked 1 all the way down to 100, and I have their fair value estimates. And in my spreadsheet, it shows the upside, and I just go off of that. So I dollar cost average every single week by looking at which stocks on my watch list are undervalued and where my capital can be best deployed today. So I don't time the market in general, but I do time my buys specifically into specific positions. No, I'm not going to buy into a company when their trading multiple is a 500 and when they're at an all-time high. No, as a value investor, I would like a little bit of a margin of safety baked in and buy into them when they're on a pullback correction or on clearance. That's just how my brain is wired. So I think the bigger question is, why do I do this? Because the dividend drip could buy back into the stock while it's at its 1-year high. Instead, I'd rather buy more of a portfolio holding that's near its 1-year low or open up a new position that has a better opportunity for the next 12 to 18 months. So between you and me and your wife's boyfriend, when people say dividends are useless, I find it comically misguided, mostly because that useless cash is exactly what I use to buy the dip into the positions in this public portfolio. Also, I think it's the most perfect time to address why do I time my buys? Shout out to the loyal Dutch for asking that question. More specifically, do you buy and sell often to create cash? So for most folks, the heavy lifting in their portfolio, allowing it to compound and get bigger, it usually comes from contributions to your 401k or weekly or bi-weekly paychecks. Most of you watching this video, you're probably clearing what? $2,000, $5,000, or even $10,000 every paycheck. And putting just a fraction of that towards your brokerage account is how you shift your mindset from being a consumer who just spends to being a business owner that has assets working for you. Because I'm telling you right now, every dollar you put to work today is a seed that you're planting that'll eventually grow into a forest of beautiful gains and passive income. That's not financial advice, it's just what we have seen historically. On the flip side of that, there's my situation. My current season of life is focused on being a stay-at-home dad. Like, I intentionally chose this life. And I'll say this, it's the most rewarding job I've ever had. It most definitely has its good and bad days, but since I'm working with a YouTube income that pays about $200 to $500 a month, this past month, I think we're gonna be just shy of $200. So needless to say, I have to be smarter than the average investor in order to keep the compounding machine going. And I say that because I don't have a paycheck that's pouring in that's the size of your paycheck, right? So I'm focusing on maximizing the efficiency of every cent and every dollar that I own in my brokerage account. Speaking of which, if you love the content and you want to support the channel, it would mean a lot to me if you would check out the links in the description. There's many different ways to do that. And if you do check it out, the Patreon and some of the other stuff I've got going on, thank you. And so what that means is I don't just buy and hold and do nothing. Instead, I'm a little more hands-on and active, like I alluded to earlier. What I'll do is I'll buy into a high-quality compounder that's on the discount and on sale, and then I'll sell out of them when they rebound or reach my price target, plus or minus 5%. Like if I have their price target as $100 and I buy into them at $60 and they reach like $105, I might wait for them to hit that 105 before I sell out. If that makes sense, at 105 instead of just at 100. But anywho, I'll then redeploy that capital into the next compounder on the dip and then just wash, rinse, and repeat. And by the end of the year, my total return, it's not too shabby. Since 2019, I have been beating the market. And when I say the market, I'm referring to the S&P 500. However, I will say there are some times where I just buy and hold, especially if it's a dividend growth investment like SCHD. And I think the next natural question is, why do I do this? Well, let's just take a look at Lockheed Martin, one of the positions that I sold for a profit. If you take a look at just the past 1 year, you'll see that their run up from December all the way up to early March was just absolutely bonkers. And no, I did not time it perfectly to sell them when they were roughly $6.92, but still, I'm a happy camper with what I walked away with. You can see, if I did nothing, then I would have watched them go from their very highs of $6.92 all the way back down to what they are today, $5.09 a share. Lockheed Martin lost 24.6% in the span of weeks. And so by sitting still and doing nothing, I wouldn't have been able to lock in the gains. Does that make sense? And we can do the exact same thing with United Health. Let's say that you bought into the dip right here, initially in May 2025. And let's just go ahead and assume that you bought, you held, and you did nothing. You would have watched your position go further into the red. Back in August, you would have been down 13.3%. And then you would have witnessed the rebound and you would have seen yourself be in the green. What is this? 33.4%. But by doing nothing, again, you would have watched your position wither away and go back into the red. But granted, if you did nothing, now you would be back into the green, 35.1%. So what I'm trying to say is you can sell them right here, or you can sell them right here. Initially, I did not want to sell out of them back in the fall because my life was super busy with the birth of my first baby girl. So I wasn't able to strategically time the exit. But when this time came around and with the pending move back to the States, I was like, you know what? I think it's an appropriate time to seize the profits. No, but really, why are you doing this? Because based on my experience in the stock market, what I have seen is once a compounder hits my projected price target, the upside is usually capped. Now, I will admit, I'm not always correct with that logic, but 8 out of 10 times, it's usually sound. So, because the upside is usually capped, it leaves me with a lot of downside risk and very little room for further growth. Now, obviously, 5, 10, 20 years down the road, United Health will be a lot higher than they are today. Now, obviously, that's not financial advice. That's predicated upon them executing and them crushing in their operations. Can things change 3 months, 9 months from now? Absolutely. But if things stay the same and they continue to be the #1 biggest health player in the US, I think they'll be a $600 stock by 2029. Usually when a stock hovers around my price target, if anything happens, if someone walks into their business lobby and even lets out a small little fart, that might be enough to send the stock just tumbling. A scandal, a setback, because you're priced for perfection at that point, because you're trading for the price you should be. And so for me, I have learned time and time again, it's okay to sell and reap the profits. And as a reminder, for my dividend income portfolio, entirely different mindset. I do not sell my positions because the whole name of the game is for the dividend growth to do the heavy lifting in the CAGR portion of the total return ingredient. And as a matter of fact, due to selling out of the positions that I revealed at the beginning of the video, I've been slowly but surely dollar cost averaging into a new position that the Patreon already knows about. In the next episode, hopefully I can upload that video sooner than later. You guys will find out which compounder I think is undervalued right now because I'm putting my money where my mouth is. I know all of this, it sounds a bit unconventional, but hopefully that makes sense as to why I don't do drip and why I time my buys. This strategy, it's really tailored to my specific goals, my risk tolerance, and it makes sense for me. However, it might not make sense for anyone else. And truthfully, I think most people, you're better off with a passive approach, just dollar cost averaging into VOO, which is the Vanguard's flavor and variety, the S&P 500, an ETF and index fund. Trying to pinpoint the perfect time to jump in and out of a position, I'll tell you right now, it takes an incredible amount of research. And the kicker is, you're not always going to be accurate. I mean, my trade desk position would like to have a word with you and with me. Having said that, I share all of that deep dive data with the folks over on Patreon. But on the topic of jumping in and out of stocks frequently, for the average investor, it's just not a good game plan. I would say it's okay to be satisfied with that 10 to 12% ROI that the S&P 500 gives you. There's absolutely no shame in that. Seriously. But for the crazy folks that are like me, the ones that are delusional, that feel like they can beat the market by doing individual stock picks, it's just not our cup of tea. It's like you going to Starbucks and saying, hey, I just want a black coffee with nothing in it, and everybody just giving you the side eye, like, what? You don't want 40% of your cup filled with sugar? What is wrong with you? Anyways, I think that's all for this episode. Keep your questions coming because I'll try to answer them in future uploads. And having said that, good luck in the stock market. Stay safe. I love you guys, and I will talk to you next time. See ya!